A home is often one of the most expensive assets that we can all seek to own. And with every attempt to own one, usually comes with taking on a debt called a mortgage. Now, unlike car loans or credit card debts that can often be paid off within a couple of years, mortgages can take decades to pay off, some extending to 30 years. Just imagine how much debt interest can accumulate over that time. So, I think you'll agree that it's in your best interest to try and minimize the amount of time that you spend paying off a mortgage loan. The good news is that banks and lenders can offer a solution called an offset account. To illustrate how it works, imagine that you have an existing mortgage debt of $300,000. And let's say the annual rate of interest on the loan is currently 5%. The dollar amount of annual interest would simply be calculated as 5% of $300,000, which is $15,000. Let's say now that you have an offset account which you can think of like a special bank account, and you have $50,000 of your personal savings in that account. When the bank or lender charges you interest now, it will only charge you interest on the difference between the total debt balance and your offset account savings. So in this case, the interest which you would pay each year is 5% of $250,000, which comes to $12,500. What this means is that having some money sitting in an offset account has helped you to save $2,500 in annual interest. The added benefit of this account is that you can freely have access to the money if need be. Although, if you do, then this will likely affect the interest calculation. A downside of the account is that you're not entitled to earn any interest on the savings which you deposit into it. But that's what offset accounts are. They can be a useful financial product if you're trying to reduce interest payments and cut back the years in a mortgage debt repayment plan.